3 stocks hitting their 52-week low: NVIDIA, Dell, and Garmin. Okay, I love looking at 52-week lows because this is a great place to start for a value play. Why is the stock down so much in the last year? Go check it out. Could it be a buy? Could it not be a buy? We just did a video in which a company we looked at was down 85% in the last year and a half, and guess what? It still wasn't a buy yet, according to my assumptions. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to buy when price and value are disconnected, where price is below value, long-term value. I don't care as much about quarter-to-quarter results and analyst expectations as most. I look at the long-term business potential for the company, and I determine if I'm buying shares at a cheaper price than before. The market is going to be emotional. My goal is to make money off that emotion. So please keep watching these videos. We have over 1,700 videos. And if you like what you see, subscribe to the channel. Also, if you want to see really cute puppies of mine, check me out on Instagram right here. So 3 stocks: NVIDIA, Dell, and Garmin. Let's go check out the first one. And we're going to pull up our 8 pillars software to look at the companies and decide what we're going to do with them. So let's check out NVIDIA first. So NVIDIA had a high of 346 and a 52-week low of 132. If you go back and look at our videos on NVIDIA, we talked about how it was overpriced. We talked about how is this chip growth really stable long-term? And then all of a sudden, the US started announcing that they couldn't do chips last week in China or something like that. And all of a sudden, the stock is falling even more. These are the things that we don't know are going to happen. That is my point about looking at investments. We don't know what's going to happen. So your job is to be conservative about your assumptions. So some high level things: a dividend of 0.1%, but because of how expensive the company, how high the high market cap, it's a very high dividend rate. But they can afford it easily because they did $6.3 billion last year and they did a 5-year average of $5 billion. High gross margin, high profit. Love it. High return on invested capital. Love it. So let's go check out our 8 pillars tab right here, where it'll show us everything about the company. So high PE, high 5-year PE, high 5-year free cash flow. One thing I love is that they're very close to each other. I like that a lot. It shows that they're being consistent. Shares outstanding up a little bit, which I don't blame them for because the company was expensive. So if I was a CFO, I'd be like, listen, if we need cash, let's just go issue more shares because people love our shares. So they're issuing more shares and instead of taking on debt. That's the smarter way to be financially when you're an overpriced company. All right. Revenue growth, net income growth, free cash flow growth, and a very reasonable long-term liabilities ratio. So everything overall, I like this. This looks like a situation in which I'm just waiting for the price to hit where I want it to be. So one thing new we have in our software is analyst estimates. We can click on that and look at the analysts that we get part of our data feed. In this situation, we have 47 analysts as part of our data feed. This isn't all the analysts following NVIDIA. There are many others, so go check them out. But EPS over the next 5 years expected to grow pretty significantly, over double in the next 5 years. That's 15-20% growth. Big drop for this year, though. For next year, they're calling. Okay. Now scroll down below for revenue estimates. Again, 27 to 50, almost double. You're looking at low teens number of estimates. So don't sit there and take this as the Bible. Analysts get things wrong all the time, but it's a nice guide to sit there and say, hey, what's going on? We just did a 52-week low video in which 2 of the 3 companies had analysts expecting 0 or negative revenue growth over the next 5 years. So it's a nice thing to go, oh, look at that. Let me go check this out. This company did 10% revenue growth over the last 10. Why are analysts thinking there's going to be a decline in revenue? Interesting things. It's all about telling a story. So what do we do with this, guys? Now, our next goal is, once we determine we want to look at it, what we created was our stock analyzer tool. This was the most exciting part of our software because it allows somebody to make assumptions about the future. Why do they make assumptions? Guys, the future is unknown. We don't know it, but every investment's the present value of all future cash flow. So our goal is to make assumptions about the future, input them in our stock analyzer tool, and it'll tell us what price we need to look at. From there, we determine, do we look further in the company or not based on how far we are from the price. So if you're new to this, please rewatch the stock analyzer tool part on all 3 of these stocks in this video. Rewind it, watch it. It's very valuable. First things first, I'm doing a 10-year analysis and I'm going to show, and it shows the 1, 5, and 10-year numbers here: revenue growth, profit margin, and free cash flow margin. I'm going to use this as a guide. Now, you saw the analyst expectations for revenue growth were low to mid-teens, much lower than the last 5 years and 10 years, which makes sense. There was a big run up over the last couple of years. So I'm going to go high side. We're doing 10-year analysis, not 5. So I'm going to do 14, 10, and 6% revenue growth, low, middle, and high. So I'm being conservative because I want to sit there and say, listen, what if something changes along the way next 10 years? I don't know what's going to happen. 6% revenue growth is still over double their revenue. So that's pretty awesome. All right. Profit margin. I'm going to do 22, 25, and 28. The reason being is they hit 29 in the last 5 years. So I'm going to make that my high side because there was a lot of demand in the last 5 years. And I'm going to go lower saying, okay, they can't sell as much. They have to discount some things, get rid of some inventory, and bring some more product to market. Free cash flow margin, I'm going to do the exact same thing. Now, PE. Guys, look at this PE, 43 and 53. The reasons to have high PE are high moat, which would be reflected in the return on invested capital. They're able to get high returns on the capital they're investing back in the business, and high growth. And there's some reasonable growth here. But I don't think that a high PE is stable for a company long term, because we're trying to put the PE at the end of the 10 years. And the larger the company is, the harder it is to grow, okay? So keep that in mind when you're doing this. I'm going to go down to 13, 15, and 17 PE and price of free cash flow. Now, for the desired annual return, I've already been conservative here and I'm being aggressive here. So I want a lower desired return here and a higher one here. Why is that? The lower my desired return, the higher price I'm willing to pay. I've already been conservative, so I don't want to beat it up overly, but I'm being very aggressive here. So I kind of want to beat it up and say, hey, listen, that's less likely to happen. So I want a higher return to pay for that. So if you get 9 or 10% from a long-term ETF, you want to pick a higher number than that. So for these ones, I'm going to go 12.5, 15, and 17.5% return. Now, guys, I'm going to hit the analyze button. The stock's currently at 135. If it's all green, does that mean go out and buy? No. It means go out there and do your research and make sure these assumptions are correct. How do you do that? Go see what these analysts are saying about the company. Go see what the person who believes in the company is writing and what the people who don't believe in the company is writing. Biggest thing, join our community. For less than a cup of coffee a day, you can join this with no long-term commitment. Go in there. There are thousands of investors in here who are like you, that are like-minded, who've looked at NVIDIA and probably have a lot of research done. It's easier to do research as a group than it is individually. Get other people's opinions. I assure you there'll be people in here who speak good and bad of NVIDIA. Go find out what they're saying. Go see which ones make the most sense and help guide your decisions based on that. Help guide your thinking based on that. It's not a be-all and end-all, but the point is getting other people's opinion and what they're seeing. Some might be useless, but a lot of it will be very useful for you, okay? So we hit the analyze button, and what do we got? So we've got 38, 70, and a mid price of 50, okay? Now, I have this on my watch list at 100 right now. So I added it to my watch list before. And the reason being at 100 is at that price, the stock will be falling enough where I want to sit there and start doing more research on the company and start selling puts on it. So if you want to add this to your watch list, just hit the check mark. It'll ask you right here, hit the check mark. You can either accept the price you selected or change it right here and then go about your business. Next company, Dell. Let's go back to our main page. Let's go to Dell Technologies. High 52-week high of 61, 52-week low of 36. Let's go to our 8 pillars tab. Okay. So low PE, wow, really low price of free cash flow, 4. Slight increase in shares outstanding, a little bit more debt than we want. Now, I guess my question is, how do you have 20 billion in revenue growth, 8 billion in net income, and a drop in free cash flow? So that's a question you need to ask yourself when you're doing this analysis. So let me go to the cash flow statement. My guess is it's net working capital, changes in working capital. Okay, yeah, so look at this. We had a fluke. We kind of had a fluke year here with this free cash flow number. So I would discount this quite a bit. Whenever I see flukes like that, I just go, let's pump the brakes on that. Let's go back to the 8 pillars. Okay, let's go to analyst estimates here real quick. So their EPS, not a lot of growth here, guys. 666 to 881. That's growth of low to mid single digits for 5 years. And we're going to do a 10-year analysis. So it might be worse. And let's look at revenue estimates. Oh boy. Look at this. 103 to 112. Not much growth there, guys. It's a big company. $100 billion is a lot already. It is a big company. So to grow more and more is going to be harder. So let's go to our stock analyzer tool. And again, guys, watch because I'm going to speak through this a little bit faster. So revenue growth. I'm going to go 0, 3, and 6%. Let's say they crush it and beat everybody's expectation. Actually, you know what? I won't even do that. I'm going to go -2, 0, and 2. Because I just think 6% is too high based on what we're seeing there out there from analysts. Profit margin, 3, 4, 3, 4.5, and 6. Free cash flow margin, 4, 5.5, and 7. PE, 8 because of the -2% revenue growth, 11 and 14. Actually 8, 10, and 12. Because even 2% revenue growth is way too low for me. I'm going to do the same thing for free cash flow. So guys, I'm just looking at this saying, what would I pay for a company that's declining in revenue? What multiple? If it's declining in revenue, I want to be very cautious there. I'm going to pay 8 times earnings and free cash flow because I want to get that return somehow. Desired annual return, 12.5. I'm actually going to stick with 12.5 across the board because I don't think even the high side was that ridiculous. It was a lot, but it wasn't that ridiculous. This is where it's tough, guys. This is the art of investing. 12, 14, and 16%. Let's do that. And again, I'm going to do this 100 times and come up with 100 different estimates. And that's the same thing for you. It's about feeling comfortable with this. My goal is just to be cautious and conservative, but not over the top insane. Like I'm not doing negative 10% revenue growth. Why? Because that's just insane. I mean, the company would go to zero then, which I'm fine with. It's possible, but it's probably not probable. So we go here. Oh my Lordy, look at this. We got greens all across the board. We got 28 to 38. We got 67 to 80. And we got 46 to 57. So this deserves some extra look, I believe. And I'm going to sit here and I'm going to add this to my watch list at 32 a share. Now, I'm going to go back to the 8 pillars real quick. Make sure this debt is sustainable because I don't like the low margin with the high debt. That's one thing I will say. I don't like low margin with high debt. So that's my conservative approach here, but that's what I want to do. Final company, Garmin. Give a Garmin. So Garmin isn't just, it's very well known for its technology, and that's a big factor in the company. $87 a share. Their big net revenue comes from licensing their mapping data. That's a big thing for them. Their stock was 175 a year ago in the last year, and that was pretty much its all-time high, basically, 180. All right. Ooh, big dividend. Ooh, guys, this dividend, look at this dividend. I'm glad we caught this. 3.1%. Don't just fall in love with that dividend. Here's what I see. They're going to pay out $515 million in dividends, but guess what? Look at that free cash flow. They can't really support it. Yes, in the last 5 years, they can support it, but last year was low. And in the last 5 years, they're eating up a big chunk of their free cash flow in dividends. I don't like that too much. Good margins here, 57% gross margin, 20% to the bottom line. All right, so let's see. Let's go to the 8 pillars. So I guess my question is, why are they issuing more shares? Oh, wow, very low debt. That's awesome. Revenue growth, profit growth, but cash flow is down. Okay, so this is mixed bag, but it's not scaring me off yet. I do like this a lot, but I want to see how they're going to license their data more. Let's go to the cash flow statement and just see what's going on here. Why was there a big drop when net income? That's interesting. Big drop in free cash flow. The second lowest in the last 10 years. That's interesting. So it might be a fluke, guys. All right, let's go to the analyst estimates. EPS. They still have EPS growth, high single digits. Revenue growth, low to mid single digits. Nothing great, but that's expected. I mean, what's the mapping world? I mean, I'm sure mapping is going to become very important as time goes on. Let's go to our stock analyzer tool here. All right, revenue growth. I'm going to go 0, 3, and 6. Profit margin, very consistent. I'm going to do 19. I'm going to do 18, 20, and 22. Free cash flow. I'm going to do 13, 15, and 17. PE, not a huge company. I'm going to go 11, 13, and 15. 11, 13, and 15. And the desired annual return, 12.5, 15, 17.5. Hit the analyze button. The stock's currently at $87 a share. Yeah, it's going to fall more. And you might be like, Paul, it's a 16 PE. I get that. But when you have no growth, you got to get your money from free cash flow. You got to get it that way. So a low price of 30 to 40, a high price of 50 to 65, and a middle price of 40 to 50. So you got some room to grow. To me, it's just, if you want to add it to your watch list, add it here at $50 and go from there. So guys, thanks very much. If you liked our video, please check out our next video on margin of safety and how you can understand it better. And don't forget to subscribe to our channel. Thank you very much for your time.